What I liked a lot was the hero thing. You can all be heroes, but are you all playing for the same team? Like, everyone can agree that growth is slowing, but no one can agree on how to fix it.
Yeah, that's true. I mean, what you see at the Fed, I think, are disagreements or uncertainties about three big issues. First, to what degree is this a secular problem? You know, inflation is just stuck below target on a long-run basis. Second, to what degree are the cyclical factors a little bit behind us now or still to come? The next issue is kind of related, but more important than maybe people understand. You know, the traditional idea has been that if you're close to the zero lower bound, you want to act proactively because you're not going to have that much room to stimulate if you go into recession. And so for several years, I and other people on the Fed, I think, subscribe to this notion that you are very careful about then raising rates because you don't want to do anything that might tip you into recession. I think there's some question now among some of the Fed FOMC members as to whether that approach is actually efficacious, given that the risks are things like trade and geopolitical uncertainty. And then third, I think the Fed has got itself a little bit in a position where the markets are expecting more stimulus, and they may be a bit worried that if they don't deliver it, they may induce a little bit of a shock from the markets as opposed to assuaging the markets.
So if the Fed has to choose between the markets expecting something and inflation expectations on the other hand, which do they pick? Because isn't part of the problem inflation expectations are suppressed in part because the Fed keeps cutting? I'll put a chart up here actually that indicates inflation expectations are really suppressed. If they keep cutting and say they're going to keep cutting, of course inflation expectations are suppressed.
Well, there's partly a communication problem, I think, David, because in theory, what the Fed would hope would happen is, as they cut rates because they say we are trying to assure that we meet inflation expectations and meet the target by stimulating more growth. But there is this question as to what is actually affecting inflation expectations. And the latest New York Fed survey suggested that expectations are becoming a bit unanchored.
Well, in fairness to the marketplace in terms of inflation expectations, they've tried it again and again. It hasn't worked. So at some point, the marketplace says, you know what, we don't believe that by cutting rates, it's going to increase inflation.
Well, yeah, so you've got the difference between consumer expectations and market expectations. The market expectations are pretty easy to quantify because you just look at the differences in yields. Consumer expectations, though, which should play a big part in the operation of expectations, those have been better anchored, at least up until recently.
So why is it so hard for central bankers to agree on what to do? Like, the dissents in the Fed are one thing. The dissents in the ECB feel bananas to me, like how aggressively contentious they seem to be in the media outlets, et cetera. Like, would you have expected that to happen?
Yeah, I think it's been simmering for a long time, Alex, to tell you the truth. There's been opposition to Mario Draghi almost from the minute he said he would do whatever it took in order to keep the Eurozone growing. And I think with the approaching end of his term, that opposition just felt strengthened, and they very publicly now, I think, laid a marker that if Christine Lagarde wants to continue Mario's policies, she's going to have a struggle on her hands.
Well, which makes her job particularly difficult as she comes in. Mario Draghi sort of used up a lot of the capital, perhaps, in stimulus. Does that make her the perfect person to go in because she's not an economist? She's more of a politician and a lawyer, sort of like Jay Powell is, or does it actually make her plight more difficult because she's not an economist?
Well, I think first off, I should say, given the job that Christine Lagarde did at the fund with a very difficult situation, a lot of those skills are going to be highly relevant in running the ECB. The second question, though, which you alluded to, is there something like a consensus of what we should do and that she can use as her base for moving forward? And at this juncture, it's not at all clear that's true. You know, where have Mario's allies been over the last 2 weeks as there's been all this criticism? You've almost heard only criticism.
Yes, it's been really staggering. But when you said sort of like what are the options and how do you agree, you can make that debate for the Fed too. And I was struck this week as San Francisco had a paper out. San Francisco Fed had a paper talking about negative rates and saying there might not be all that bad. They said that analyzing financial market reactions to the introduction of negative interest rates shows the entire yield curve for government bonds in those economies tends to shift lower. This suggests that negative rates may be in effect effective monetary policy tool to help ease financial conditions. I found this a little surprising, I have to be honest, that this would come out from a Fed paper.
Oh, yeah. Well, the Fed, the Fed tries to be analytic, and different parts of the Fed with their research departments do try to just do straightforward analysis. I think the point in that paper was a discrete one, which is, yes, you can see the impact in the yield curves with government securities. But it didn't, it was very careful to say that's not the only set of issues with negative rates. With negative rates, you have the issue, the psychological issue of what it means for people to feel like their savings diminish rather than grow. And for that reason, you see in the EU, for example, the Eurozone, they've exempted really retail deposits. Well, when you start exempting things, you limit the efficacy that negative rates might have. And the second thing, Alex, is, as we're seeing in the Eurozone, in Switzerland, once you're into negative rates for an extended period of time, it seems really hard to get out of them. So I would say the dangers of them are not so much the short term, what does it do to banks and all that, so much as what does it project about the economy, and are you going to be able to pull yourself out of using them eventually?
Dan, what about the basis of the analysis? And particularly, I'm mindful of the trickiness of counterfactuals. If you look at Japan, you now look at Europe, negative rates have not given you a lot of growth. Now, the defense of it is, oh, it would have been worse. Right. But how far can we go in saying what would have been and it would have been worse?
Well, you're right, David. The counterfactual is quite difficult, particularly in Japan with a declining population. I mean, basically, if you hold GDP steady in Japan, your per capita GDP is rising. So it becomes even harder to analyze what's happening. I would say this gets us to the big question of what is the Fed's new approach to monetary policy going to be? And in a way, Alex, in answer to your first question, I think there's a bit of treading water going on right now. They're kind of going meeting to meeting, almost waiting for the question of, do we have a new approach to monetary policy that helps us answer some of these questions of what to do? Is it more forward guidance? Is it sort of a Bernanke idea of trying to get average prices up over a period of time? And until they get that, I think you're seeing different camps in the Fed who have their own working assumptions, and they haven't yet come together on an agreed approach.
Well, Jamie Dimon has a suggestion for the Fed on what they can do when it comes to the repo market. So this was actually on the earnings call this week. Jamie Dimon was basically saying that they had money to go in and help the repo market, but they couldn't deploy it, but they would have been happy to do it. The idea is, it's your fault, Dan. It's the regulation that prevents them from actually going out into the market and lending this.
Yeah, so the banks were pretty quick to identify regulation as the problem here. It was interesting. Different banks and bank lobbyists identified different regulations, so there wasn't a totally cohesive position on this. A few of them don't seem to hold much water. Jamie Dimon mentioned something in the earnings call that I think does bear looking a bit at, and that is the expectations for liquidity around the resolution plans. And I would say I have always had a little bit of a concern about the post-crisis liquidity regulation generally. I'm actually more concerned about whether the liquidity will be used during stress periods. But I think there are two big questions here. First, do we really want a situation in which the banks are just intermediating as much short-term funding as markets want? That was what led to the crisis in the first place. And so there's a reason why that regulation is in place. Secondly, the Treasury market has changed. 10, 15 years ago, who was the incremental buyer of Treasuries? The People's Bank of China. 8 or 9 years ago was the Federal Reserve. Today, it's second-tier primary dealers. And that means it has to be financed. And how is it going to be financed is really an open question right now. So just as with monetary policy, I think there's a set of deeper questions as the fiscal deficits increase during peacetime and non-recession situations that are going to have to be talked about before you have a sensible resolution to things like short-term liquidity squeezes.